Hey, good morning, good afternoon. Hello, hello. Hey, Tom. Tom, if you're saying you're on mute.
Yeah, hello. Hi, Vivek.
Hey, how are you?
Good morning.
I also see Joe. Hey, Joe, how are you?
Oh, I'm very well. Thank you for the invitation.
Yeah. Joe, is this a first time for you
It
in this
is my first time. I recognize a face right to my right. Hi, Tom.
Hello, good morning, Joe.
Good morning to
meeting?
you.
Okay, we got some old friends here. Good, good. All right, so what brings you here, Joe?
Oh, I've been options trader for many, many years, going on two generations.
Great.
And it's nice to be able to associate with people that are in the industry as well.
Cool. Cool. Yeah. So I think I and probably the group can learn a lot from you. Uh, because you've been probably trading options way longer than I have been. But for me, options is just one tool in my overall toolbox. I'm I moved from only doing options to now become a lot more as a just buying great business and use options as a gravy on top of meat. So. But there are folks in our group and they join the meeting and we'll talk in the breakout rooms, which are like purely option traders. That some don't want to do anything with the stock, which is also right. I mean, nothing wrong in that. Ju- Just that I guess everyone has to figure out what works for them.
Yeah, absolutely. Everybody has their own preferences, likes, and so be it. I wish everybody good luck in their and good investing, speculation, or long-term investing, and good luck
Right.
to everybody.
Cool. Glad you joined today, and hopefully we'll see you next week also. Hey Fred, you were saying something, Alfred?
Yeah, in regards to let you know, I think first
You,
week of May,
sorry,
we're
you're
gonna
you're
have an
breaking.
invest.
Alfred, you're breaking up a
Yeah,
lot.
yeah, sure.
Yeah,
Hello,
you're
something my
breaking your
connection.
yeah, your voice is cracking up a lot. All right. Anyone else here joining for the first time? Oh, I see the name.
Hello, everyone. My name is Jojo. I think it's my first time here.
Hey Jojo, welcome. What brings you here?
Uh, I just hope to learn something. Actually, I'm work for institutional investor in China for more than 10 years. And since 2024, I moved to the US. But now I'm working on the AI agent. And I'm very interested in the US market too. So that's why I'm here today.
All right. Cool. I started this group as a DIY investor. Now we are some ex-institution folks. So great to have the mix. Welcome, Jojo.
Thank you.
All right. I guess I see other names. Probably your regular crowd here. So anyway, I was reading through on there was an article on Bloomberg around an option strategy, and I'll start our discussion today's discussion with that, which is around pretty safe strategy, iron condor, and how one of a trader, I guess an institutional trader, or maybe a prop trader, I don't know, how he blew up his account. So we'll start with the that education, and then we'll move on from there. Alfred say max 7 will be 0 DT 3 times a week. Ah, good. I don't do 0 DT trade, so I don't have to worry about it. Yeah, James say gambling issues, bring it on. But I was reading that these 0 DTEs, the advent of 0 DTs, and we started seeing a lot of a pickup in these, I think from 2020 2022 onwards, and now they have become majority of the trades on majority of the option contracts traded on CBO is 0 DT. I think some part of a time like 40% of the SPX trades on a particular day are all 0 DTE. But hey, these are the tools you want to use the way you want to. I'm no one is judging here. But I think there was a study which says after the advent of the 0 DTE, the volatility has come down in the market, which was a little surprising. I thought it makes a lot more volatile. But what do I know? Uh, anyway, also first week of May, Charles Shaw will be back in Bay Area. Uh, is it in? I think they probably maybe in Sacramento or somewhere, because on Santa Clara, I don't know. I'll have to check on Charles Shaw. But if they do, it will be an opportunity to meet some of you. I do go and attend, those Charles Shaw couple of days of event, their weekend events. They do it once every year. All right, so guess we get started today, guys. All right, let's make sure you see the right screen. Okay. You guys see the document? I just have to make sure that I'm sharing the right screen.
Yes,
Yes,
we
we
see
see
it.
All right, cool. Okay, so we are back in earnings season, so we'll start with that. Hey, welcome everyone to our discussion number 308 for our weekend investing dojo. So today are two main topics. One, I do want to get into take you through the Iron Condor, Captain Condor, as the trader is called, and Fiasco, and how they blew up, I think, some $32 million. Seemingly very safe strategy. If you've been trading options, you would know it, the defined risk. And but somehow that risk will manifest itself if you become too big. I want to go through that strategy just as a reminder that, um, you know, even though media will talk about it is because the guy's been selling options is bad. But if you know how to manage your risk, um, that was the best hack for me in the markets, is just to reduce my cost basis, chip on a premium, and generate some cash flow. But if you take your eye off the risk and not manage your risk, you can also end up in blowing your account. We have seen it in the markets many times. So we'll go through that. Also, it's an earnings season, and at least the companies that I'm interested in, TSMC, I hold in my portfolio. It reported earnings, so we'll start with that. And a result of that was that all the chip stocks, they just rallied. So this is main to also look into what's happening in the market, what happened in the market this week, what happened on the crypto side, so on and so forth. So any questions, feel free to put in a chat. And then after the regular content coverage, we'll jump into the breakout rooms to have a little more open house, discuss whatever else is in your, on your mind, or any other topic you wanna bring it on. Cool. Before that, anyone else learned anything new, anything unique that you want to bring up? All right, looks like all's good.
Vivek,
Yeah.
if you feel like it, could you go for Rubric? The stock is doing pretty bad, but uh, on Thursday, Kramer was really pumping it. They had the CEO on.
Okay. So Bipul Sinha was on Kramer show. I don't know. So you know my deal, right? If you want me to pick up a stock and maybe bring up for analysis next week, you have to give me a few things. One, who is the CEO of the company? What's the market cap of the company? And now I'm adding a couple of more things, is what's the latest annual revenue and earnings per share. These four things you tell me, we'll bring it up for discussion next week. And it's easy to find this information, Sam. Who's the CEO? What's the market cap? What's the latest annual revenue and the EPS? Okay, so guys, let's get started. As always, anything that we discuss here is only for education. So don't go and trade based solely on. This is what I heard from Vivek or others on Saturday morning. Okay, that's never a right way to invest. So do your own due diligence. Everyone is a different investor here. We bring up a lot of topics, bring up a lot of ideas. Some may work, some may not work. You got to be the judge of what works for you. All right. So as always, I want to start with some thoughts around investing, and I have said it over like this. We are entering what, 6th year of our discussion. Said it again and again. The most important lesson that I have learned in investing is position size. Right. This is from my perspective is the least talked about, but the most important factor when it comes to investing, especially if you're doing trades like option trades, right? You could go wrong in everything else. You could have picked up the wrong strategy. You could pick up the wrong stock underlying to trade options on, or if you just want to do a stock investor, you could have picked up a wrong expiration. You could have picked up, a wrong delta to sell or buy options. You can go wrong on everything else. But if you have been prudent in your position sizing, you will survive to fight another day. Most of the discussion in investing forums or on financial media or on podcasts, etc., is all about how to find great stocks, how to find great option strategy. If you're a day trader, etc., or if you're a TA, there are a bunch of strategies that you can do. Least talked about is position sizing. My own journey, I think this is the most important factor. I've seen many times over and over smartest investors slash traders slash hedge fund managers blowing up their account because they went wrong in position sizing. Everything else was correct. Only thing that was wrong was position sizing. James Cordier, anyone remembers James Cordier? We talked about it when he blew up his account. Those who are option traders probably will remember. James Cordier, he was call it a owner, CEO of a hedge fund called optionsellers.com. That guy, in fact, wrote a book on option selling. He had a website called Option Sellers, and I think he was also a money manager for almost 200 plus families. He became viral. His video became viral. I think it was in 2019 or 2020 early. I don't remember exact time, but he recorded an apology. It's like an apology video, almost crying. You would, if you go, look at that video, you'll feel like he was about to shoot himself at the end. Apologizing how he blew up all the money that the families had entrusted him with for investment. And only thing that was wrong in that trade was he became too big on natural gas futures.
So
So
options on the futures on natural gas. That's what he was doing.
yeah, exactly. So natural gas, which generally does, I mean, it's been pretty stable. I think it was somewhere in September, there was a cold wave. I don't recall, like somewhere.
Basically, options on futures are hugely leveraged because futures in themselves are a very leveraged animal.
Yeah, and I think here that short calls on those futures, and on one fine day, natural gas was like just spiked up, like how we are seeing silver spiking up, right? 90-degree chart, someone mentioned. So, and his strategy was right because he knew that it was overextended, but his account wasn't big enough to hold that position, and he got margin call and everything else. So not only he lost all the penny for his 200 plus clients, but those clients actually owed money to the brokerage firm, because I think the way it was structured were SMAs, which is separately managed accounts. That means each of the clients had their own accounts, and not a typical hedge fund structure wherein you pull in the money and it's all hedge fund. So there's some crazy story, right? So
And
again,
also, I guess they basically, this is natural gas, and it's a futures market where they probably were the market.
yeah,
This guy James Cordier was probably the market.
who knows? And if his position size was not too big, he was proven right. Natural gas, the prices came down and everything was okay, but he blew up. 2020 is it 2021, right? Gabe Plotkin, Melvin Capital, super smart guy, Harvard educated, Ivy League. I think he worked for Stanley Druckenmiller or Steve Cohen, one of them. Prodigy. Started his own hedge fund, Melvin Capital, took a short position in GME. And I think many other people had short position in GME because it's supposed to be a dead company, GameStop, but you never know when the Reddit crowd came after him. Comes after you. Oh, he had to wind up his hedge fund because it was too big on one particular stock. Okay. Thesis proven right. GME stock, if you look at it from $400, it has now came back on earth, right? But his position size was too big, couldn't hold it. And yeah, at some point of time, we were looking at, I think this is probably maybe post split, or and this is what, 2021. Yeah, this is post split. I guess I remember it was around $400, right?
I was
And even proven right, but blew up his hedge fund because too big position size, short position on GME. And we also know some of the other short sellers, right? They stopped their business of short selling because Reddit crowd could come after them. Bill Wang, Archegos Capital Management, again, Tiger, one of the Tiger Cubs, trained under Julian Robertson's, the famed Wall Street investor, trader, and blew up his account, facing, I don't know, now he's probably sitting in jail because he was indicted. Handful of stocks, all levered up, right? Not well diversified. It works. Leverage positions, huge position size works until it doesn't, right? And at that point of a time, all those stocks that he was in, a couple of Chinese stocks, Viacom, CBS, and basically had levered positions across different banks, and the banks did not know that he's already, had raised money on margin against these stocks with some other bank. And when the stocks went down, he got a margin calls from multiple banks all together, and obviously he couldn't honor those calls. Not only his hedge fund folded up, the banks who had lent the money, they also suffered almost $10 billion. And whenever these things happen, one name which always comes around all these fiascos is a Credit Suisse. I don't know what their risk management stuff is. Anything that has gone wrong in Wall Street, you will see Credit Suisse fingerprint. They somehow get involved in all of those things, right? So again, if probably there are a lot more. Yesterday while I was preparing the doc, I could remember all these three. But there are anytime I see a hedge fund blowing up, people losing money, even including DIY retail investors, coming and then crying on social media. If you dig deeper and see, come on, guys, you were too big. You were too big in a position. Everything else was right. Your strategy was right. The stock you picked up was right. You short GME, which was a great thing to do, right? Because GME has come down from now post split $120 to $20. It's a great shot, but you became too big, couldn't hold your position. And that's what it said, right? Market can remain irrational longer than your portfolio can remain solvent. And that's exactly what happened. If you go too big, you get bitten in your back end. So we can now add one more name to this list. which is Captain Condor. Interesting study. You can go and read it on the Bloomberg. And I was like, what the heck happened? And not only he lost his money, he's some 32-year-old day trader. And not only he, but they had his like bunch of followers, traders who pay him like $5,500 annually for access to his trading plans, right? Share his trade strategies and how to trade and on all that stuff. So all he did was basically used to do SPX, iron condors in XPX, and that's why his name is like Captain Condor. And I think his hedge fund has SPX management. And if you know iron condor, it's a pretty well defined risk trade, right? You know exactly how much you're gonna lose in an individual trade because you sell a put spread, you sell a call spread, trading on both sides of the market, and you hope, or you when you look at the numbers, pick up your deltas, assuming that the SPX or whatever the underlying is will stay between your break-even positions or between your short strikes at expiration, and you're gonna make some premium, right? And works out pretty well over a long period of time. You can start chipping away some of the premiums, month after month, depending on how you want to trade. I do iron condor on the stocks which are larger in value because I don't want to do a strangle, let's say on Mercado Libre or ASML, because those are like 1,500 and $2,200 individual stock, right? Too much of it will block a lot of buying power. So iron condor, pretty safe strategy, and that's what this trader did. Daniel Show. Uh, Option experts note that the condors can be effective strategy when executed correctly, right? But what they applied was something called a martingale method. Anyone even aware of this? I'm not a day trader. I'm not a prop. I'm like a DIY investor. Don't. I've never heard of this stuff. Anyone else?
Yep, it's like you buy, you do a trade, and then and then continuously you double the size. Actually, you keep on increasing the size of the trade.
Okay. All right. Lot more people know about it. I had no idea. So this is what is called martingale method. Is called doubling your position after losses. So over several days, he repeatedly sold iron condors, and the wager was the S&P will remain in a narrow range, and he doubled your position whenever the index moved outside. Right? It means basically it defied the math, because if you're picking up your 16 delta position, which is one standard deviation, close to 68.2% of the time, the stocks should stay between the 16 delta position. If it has moved out, martingale method, as mentioned in the report, and as you guys told, you double your position because hey, math will eventually work out. So that, but for me, that was a mistake. Number one is, hey, you became too cocky here. That
So you're
you
not
got to be
actually
right.
rolling it. You're not
So
rolling it. You are just buying a new one. Like you are.
yeah. So here basically, I don't know what the martingale method, but while reading through the article, I realized that you just double up your position. Maybe for that expiration, and someone else can tell me who have done that. Maybe he rolled for the next, and then you double up, assuming that the market will correct back, and I'm gonna make a lot more money. So mistake number one, when I was reading through it, you became too cocky. You're like, I'm right. Market is wrong. It has to come back, right? Then by December 23rd, his positions were like 90,000 contracts. Mistake number two. You could stay cocky, but maybe have a fewer number of contracts, you will still survive. You will have some bruises, right? But none of them would be fatal. So second thing was that he kept adding his position, that it was almost 90,000 contracts. And as the trading, because nearing Christmas holidays, when the trading volume is really low, S&P 500 options was second lowest of the year on Christmas holiday, right? And the lowest was near the Thanksgiving weekend, and it was the second lowest. And what happens when the activity is lowest? When the volume is low, the markets can move. Fewer trades can move the markets. And so even though S&P on SPX, it's a very deep, very liquid market, but when it is like a second lowest of the year, and when everyone else can see the positions, because this is very transparent, and I'm not implying any nefarious trades that someone else might have done, but the participants could see that if SPX stays here, how much of a, how much of money can be lost in all those option contracts, right? Low liquidity, transparent market, it's a recipe for disaster. And and anything, if you know about Wall Street, it is a dog eat dog world. Right? If nothing gives more pleasure to some of the Wall Street traders than blowing up someone else's account. Again, I don't know. There are some insinuations that market makers knew, and they basically pushed the S&P SPX to that price. We'll call this is also called what, Max Pain theory, and it blew up the account. So anyway, the spreads were very tight, only 5 points. So like selling 6890, 6885 on the put side, so if you look at it, hey, it's only a $5 wide spread. At max, I can lose in a contract is $500. We do all the time, right? I do on SPX. I sell strangles at set on QQQ and SPY and XSPs, but it's a $5 spread. But because of the number of contracts, he generated roughly $13 million in premium. But because the SPX moved out of a range, I mean, had only 0.3% on December 24th, he lost about $32 million. Okay. So individual trade wasn't bad. I will never fault anyone for doing a $5 white iron Condor. Come on, it's pretty safe. Right? Max you're gonna lose is $5. Right? How does it matter if you are managing, a few $100,000 account? Individual trade is not bad. So you had everything right. You picked up the most liquid. If you're selling options, liquidity is king. Picked up the most liquid ticker to trade in. Picked up the safest strategy to trade in. It's a defined risk strategy. Picked up the width so that you don't lose too much money, right? Didn't pick up direction, played on the both sides of the market because you never know where the market could go. Even that was right. It's an overall position in aggregate, that killed him. And while I was reading it yesterday, I'm like, come on, one more trader or hedge fund blowing up because just became either too greedy, too cocky. I don't know, whatever you may call him. I guess this is why I'm a big fan of behavioral investing. No IQ, no amount of IQ could save you. Right? Probably he's a smart investor with great IQ, good education background. All it needed was EQ. Right? And there were some quotes in that, and I thought I really liked it, probably gonna use it more often. In real markets, capital, margin, and liquidity constraints hit long before the math saves you. And if you're selling options, we base our trade looking at the math. We pick up the deltas because we know over a long period of time, if we do enough trades, those deltas will come true. And if I track, and I shared like end of year, the numbers, and I've been tracking my trade since 2018 very diligently. 2017, I wasn't that focused on it. And over like 5-6 years, if you look at all my, profitable trades, if you're selling 16 delta, 70% probability of profits, actually 70% of the trades did make money. And if you keep on rolling it, you probably bump up your percentages more than 70. So the math does work out, right? But capital, margin, liquidity, is your account big enough to hold it position? That will hit you before the math will save you. You have to wait for your position. Your portfolio should be able to hold your position before the math works out, don't become too big in any position. That is why, and I'm like pissed off with when I see on a Twitter, give me one ticker in which you go all in. I'm like, that ticker can't even be me. Right? I'm not gonna go all in even on myself. I don't want to play those games. That's another one is if you hit losing streak, you can't try to recoup it all at once. That's a gambler's fallacy, not investing. And looks like someone who probably have experience on casinos. This is a strategy martingale that's also being used by gamblers. You know, I never I have never gambled and I didn't know about this particular strategy. But again, a grim reminder, position size is very, very important. Stay humble. You could be right on everything else. You could be right on the direction, the ticker, the strategy. But if you're wrong on position size, it's very easy to blow up account. And when it comes to investing, all we gotta do is figure out how not to make these stupid mistakes. Market has got a tailwind to the upside anyway. Why we have to come in front of that tailwind in blowing up our own accounts, and then we basically complain that markets are red, oh, it's difficult to make money, it's a gambling. No, we all end up doing just stupid mistakes. So I thought I'll start our discussion with that lesson learned time and again in terms of traders slash investors getting too cocky, getting too big in position size, and blowing up their accounts. I would rather learn from mistakes of these investors slash traders than commit these mistakes myself. Hope, and I sincerely hope you also learn from mistakes of others. Right? I see hands up from Gupta. Go ahead.
Hey,
Or
do you use any software for tracking your trades, or you do it manually Excel?
There is no better software than Excel.
I think
Yeah, it's complicated when you have to analyze like all the R and Condors or spreads
yeah.
or butterflies. So like put them every day, and then you have to fetch every day. If you forget one day, it's hard to go back in the
Yeah, it
history.
depends on how many trades you do. I mean, I did it along with my job, so I wasn't doing too many trades. Now I'm full time over past few years, so now it's even easier. But yeah, I mean, I find the value of doing it has changed me as an investor because now exactly know what I did. I have a data to go back and see what worked, what did not work, what's biggest losers, biggest gainers, which day I made money, which I did not, how many percentage trades, every strategy, every taker, what strategy worked. It has helped me tremendously. And if that means I have to invest maybe 10 minutes a day in manual inputting a trades, I think that's an investment worthwhile.
Or I think like just stay with simple bets. So stocks and simple long or short put options kind of thing. Not like complicated four-legged beasts or
Yeah.
over-the-counter derivatives and all, because I've worked in those worlds. And anytime you get into these things which have 16 moving parts, like five knobs on an option, you will get into trouble.
Unfortunately, in investing, I think a lot of investors and maybe also some of the market also kind of make it. We think the more the complicated means it's a better stuff. No, whereas the simpler the strategy or simplifying your investment life is probably the best thing in life.
I agree.
Investing is like I don't know who said it, but I've been saying it for years. Investing is simple, but it's not easy, right? It is very simple. If you just don't want to do anything complex, you could just buy index ETF and be done with it.
Yeah, but
We
these
have
people
done.
want to make a lot of money very fast. That's why they do this.
We just want to complicate the stuff because I think we are wired in a way in which think if it is a simple mint, it's really not worthwhile. It is not gonna produce the fruits that we want it to. Right? Which is why most of many I think there are numbers, there are stats that many high IQ people, like most of the doctors, engineers, are very bad in investing. Because our mind can't even comprehend the fact that doing a very simple thing can actually make money. And we all wonder, how could it be? And we try to complicate the stuff. And we think more we get involved, more complicated the stuff is. Maybe it gives us a maybe an appearance that we are in a control. In real actuality, we are not. So anyway, Mike, I think you covered this fiasco. Focus on what instruments are being used. Yeah.
In other words, like only,
even
I would be, you would be hard pressed to find fiascos with respect to position sizing if it was a stock-based bet or
so I
except
think
like the GME guy, I know they ran him up because they discovered gamma squeeze works.
yeah. So I didn't know about in terms of how
All of these guys, they use, I can bet, ISDA derivatives, which are over-the-counter derivatives.
Okay.
So they're, so those markets, as I said, like if one guy, Bill Hoang, is the major holder of those instruments, he can be ganged up on by the other guys.
Yeah. No, I think his case was different. On one, I remember, I mean, I was active in the markets when this blew up, and we talked about it in our next Saturday session. On one particular day, there was one earnings announcement that had happened related to the streaming service. I don't think it was Viacom CBS's announcement, maybe, but he was levered up in a very few stocks.
Levered up, yeah.
Yeah, he was on, I think, Warner Brother Discovery, Viacom CBS, a couple of Chinese stocks, etc. He was levered up on those stocks, and there was one earnings announcement that caused volatility, and in multiple of these stocks on the same day, and it blew up.
Yeah, that's because he didn't have a value at risk computation daily in his.
Yeah, and I think the major issue was that none of the other banks who gave him that margin credit knew that kind of he is already levered up to his nose by taking a loan through the other bank. And many of the banks blew up. The bank's capital blew up, almost 10 billion.
Prime brokers on the other side do their own risk management on a daily basis, so they can track that guy. But anyway.
Whatever. So at the end of the day, fear positions too big. Yes, go ahead, Joe.
Yeah, sorry, my hand icon doesn't appear at the bottom, but thank you for recognizing that. I was interested in what your adjustment strategies are for your zeros, zero ICs, and what your criteria for adjusting is.
I don't even do any zero DT trades.
Oh, I thought you said you did zero iron.
No, I do iron condors, but I don't do zero DT trades because that's like too much of a gamma risk on that one, and that will need me to be hooked to my computer, and I don't want to live that life.
I understand completely.
So there are other people who do zero DTs. I think maybe in my life I've done maybe one or two. I don't do zero DTs. So my most of my trades would be the regular monthly trades until there is an earnings, which is like right now earnings are coming up. So I probably are doing some trades before the earnings, which is weekly expiration. Most of my trades, which are non-monthly, would be trying to hedging the trades, right? Mostly selling calls against index ETFs. Those are the one I've become more active over last few years because now I have more time in terms of like micromanaging, doing weekly trades. So right now I have like 23rd Jan, 30th Jan, a lot of calls that I've sold on QQQs, SPYs, XSP. Those I do on a much lower DTEs, which is like 7 days. Otherwise, on my individual stock positions, the regular premium harvesting are all, I start selling it around 50 days to expiration and will sell it all the way to maybe 25 days to expiration if vol is still higher. And then I don't sell any new position. Then beyond lower than 25 days to expiration, it's all managing the position that might have gone bad. If they are making money, close it, put in a new one.
Yeah, typical.
That's my style.
Yeah, typical
Vivek, quick.
covered
Sorry,
call.
go ahead. So, do you also rebalance your position? Like, example, like I had Nvidia when it was like the average price is now $18, and then like the percentage of the Nvidia in my portfolio is like almost like a too high actually, like 30%, maybe 35%. So, do you balance that? Actually, you sell and keep it in the some limitation.
So my thought on this one is you have to figure out if you start to lose your sleep, then it is time to lower your allocation to that particular ticker. And for some it could be 20%, some it could be 30%, some might be just okay holding 50%. So I just use my sleep barometer. And I think me personally would not be comfortable holding 30% in individual stock. But I know some of the other investors, they are very concentrated and they are okay with it. And I mean, nothing wrong in that as long as you can sleep well. So that is why if my biggest position, if you look at the, I think I shared, I mean, I always share in the first session after the end of a month, but I also tweet is my biggest position is still SPY, right? Almost 15% in SPY. My second biggest is just close to 6.5%. I don't think me personally will be comfortable holding 30% position in any individual company. But that's just me, given my situation. But I follow some folks on Twitter, great investors, and they had like 40% position in Nvidia. More power to them. They can sleep well with that. I cannot. So yeah, I don't think I have any like scientific answer. It's a lot more art, and depending on who you are and how you feel about your position. I just apply my sleep factor. If I'm losing sleep on it, probably it's too big a position. And I don't care what anyone else has to say that Nvidia is the greatest company on earth. For me, no investment is worth losing sleep. So I would like to know.
Thank you. Makes sense.
All right. So what happened on the market side? So okay. So there's a question. So Mike, you have a huge paragraph. Would you like to speak to it? It will take me a lot of time to go through it, and maybe I'll miss out
My
some.
point was that I quickly noticed that you said you start selling, you sell an option with 50 days left to expiration, and then like do something like 25 days, you rebalance or whatever. The key question is, we know the whole, I think, I don't know, maybe, I think the rationale for selling the put option is to exploit the theta or the time decay value of it, which is the most closer as it becomes closer to the expiration. So
Agreed.
why are you wasting your time in the first 25 days?
Agreed. So the answer to this is you are only looking at the one side of the equation, which is the profit in terms of the theta decay. And I agree with you, near to 20 days, last 2 weeks, the theta drops dramatically. It decays dramatically. But what you're ignoring is the impact of a gamma, which is also Mr. Gamma comes to the party with huge ferocity as you get closer to expiration. So if you really go back and I've looked at the studies in terms of the risk versus reward, the amount of reward per unit of risk actually start to decrease when you are 21 days to expiration or getting closer to 2 to 3 weeks to expiration. So that is why I don't want to stay in a position unless I'm trying to manage it very actively, because the position hasn't made money and I want to keep an eye on it and manage it actively. If it is made, let's say 40% of max profit I could have made, my target is 50 to 60%. But even if it has made 40% and I'm looking at a 20 days to expiration, I will close it. Because the per unit reward versus risk, that actually starts to decline as you get closer to expiration because of the gamma showing up in your trade. That's the
So
reason.
essentially, you don't let options expire, you just have them closed.
Most of the time I'll close it, yeah.
Interesting.
Yeah. And the closer you get on, the problem with this is the closer you go on to it, the very small movement in your underlying will make your option position move a lot. So it could happen that the position that was profitable, let's say 25 days to expiration, and now later on the stock moved a bit and it now become a loser. So I want to make sure that, hey, I made money and I'm gonna move and roll it to the next. So there are studies that you can look at it, which actually tells you that the reward per unit of risk that starts to decline closer to three weeks, 2 weeks to expiration. That is why. And it's not that I'm always able to do it, but if I still have a positions, then I watch them on everyday basis because I know that these could move a lot. All right.
Okay.
Cool. So what happened? Yeah, go ahead, Joe.
Oh, so my question is the same. Zero DTE, the iron condors. I was just still wondering, or whatever days to expiration you have on those ICs. What is your criteria for managing it? And
So based on what he just said, he would never have zero DT because it's very close to expiration. He doesn't want any option open when it's close to expiration because the gamma is very high,
yeah, I
which means it can
understand.
bounce.
But do you adjust them at all?
I do. Yeah. I mean, the positions that I will still keep are the one which I'm still managing and adjusting, right? Let's say if I sold a strangle and then the stock has fallen down, so it has increased my deltas. And like yesterday, I adjusted some positions for February expiration because the stock has fallen down, it increased delta, so I had to roll down my call to basically reduce those deltas and came back to what I was more comfortable with.
Yeah, sorry, I guess I'm not making myself clear, but specifically to the iron condors.
Iron condors are very difficult to adjust. I have tried to, but whenever we have a defined risk positions or a spreads are notoriously difficult to adjust because uh, not all individual stocks have that tight beta spreads like you have it in SPX or SPY. So I do try to adjust it, but I also found that when I try to adjust it, sometimes I get the stock will come back and whipsaw me. So now when it comes to the iron condor, I will wait, or the spreads, then I will wait in the last moment, maybe last week, to try to put an adjusting position. And if it is a loser, it's loser. I mean, the beauty of the iron condor, or from that matter, any spread is I know exactly how much I'm going to lose in this position, right? And then if I'm comfortable with that, it's fine. Like I have a ASML, I don't have an iron condor. I sold a call spread on ASML, 1200, 1230. It expiring in February. I think that time the um, the stock was okay. Let me just look at it. Hold on.
Have you utilized any of the newer backtesting technologies and bots?
No.
Quite
So
impressive.
ASML.
Actually, scary impressive.
So ASML is 30th Jan, not even February. It's the 30th Jan. And when I did the trade, I did on 1226. The short strike was near 20 delta. And I own the stock. So I knew exactly if it blows through my call spread, I'm going to lose 3,000 on option rate. But because I own the stock, I also know how much I'm going to make on the long stock position. And I know exactly then, is it really worthwhile or not? And I thought, okay, hey, if it closes full ITM, overall position will still be profitable. So I'm still holding this and probably close the option trade for a loss, made lot more money on the long stock. Maybe I'll sell a couple of shares to overall compensate for it, and I'm fine with it. So yeah, and sometimes when some of those puts don't work out, you'll roll it. But that's the life. I guess not all trades will work out. But I have seen that trying to adjust the defined risk, it's difficult, especially these big ticket stocks. So
So if you have a, sorry, go ahead.
So if you're not, when you're putting a spread trade, and if you're not comfortable, because you can max lose only that much amount, if you close your spread before the expiration. Or if the spread is completely in the money, then it's fine. And we know, we looked at the risk when the stock is between your strikes, then what is the risk available? But you exactly know how much you're going to lose. And if you're not comfortable with that, don't put the trade. Don't put the trade. So you do all your calculations prior to doing the trade, especially when you're selling options. The most important time, I guess, you should do all your study is before you put the trade. After that, there's nothing much you can do. You already know your max gain in that, which is the premium that you've received. After that, it's just managing. So if you're not comfortable, don't put on the trade.
Why bother?
Yeah, go ahead, Joe.
I have a question to the community. I was wondering if anybody out there is doing non-directional time spreads.
I just stay with simple selling of put or call options for a 5-day period because I want to exploit the time decay, and I don't think it's going to close very far out of the strike for me to kind of seriously get upset and jump out a window. So why waste money on a second leg and do this damn vertical?
So
I guess I didn't hear what you said. Is it a diagonal or?
No, I just sell a simple one leg option.
Oh.
Either put or call. What I'm saying is I'm not bothered with giving away money on the second leg, and I don't care for whether it closes somewhat out of the strike. I'm happy to part with my stock or buy it.
So when it comes to the non-directional, Joe, I have done non-directional trades. Like say this week, I did straddle because the VIX was like up to 16 or 17. So I actually became a little more aggressive and sold straddle on SPY. I think they did a couple of trades. One I did was a strangle, I think 16 delta strangle. One I did was a straddle. Both are non-directional. My only motive behind that was premium harvesting because the VIX was higher. And I'll manage it if it goes against me.
Yeah. I primarily do non-directionals with out-of-the-money calendars and diagonals as a combination, and get a wide, very wide, sometimes 300 points on the SPX. It's kind of a trade you can take your eye off the ball, you can walk away from it. And so it's making money going either direction. Whether it's a calendar or a vertical is relative to the implied volatility. But what's very appealing to me and what drew me into that is the risk to reward is in your favor, whereas the uh, the iron condor is not. You can win way more than you can lose. Whereas the
So
iron
Joe, how
condor,
far do you go?
how far do I go? It's kind of relative to my days till expiration, and I do them, I can do them weekly, I can do them every 14 days. I'll do the long position relative to implied volatility on the VIX. Uh, 3 days with between the short and the long. If I go out farther in time with the long, I could go 4 days between the short and the long, and I'll get sometimes I can get a 300-point move on the SPX in either direction, and then just let theta decay take care of it. It adjusts relative to implied volatility. It wants to go up of course, in low volatility. Those are the nice. Those are the advantage.
What delta do you usually go?
We'll go up 20 delta, 15 delta, 10.
Okay.
Not really 10 delta, but I do but whatever delta I go out and I want to do it.
It's within your managed risk, right?
Yeah, you get as close to, when you set it up, you get as close to neutral delta as possible.
Oh, I see. Okay.
So Joe, let me ask a question actually. So do you guys draw the market structure level on SPX? How do you guys decide which direction is gonna go? Do you guys use gamma exposure, or do you guys use a support and resistance? So is there any way that ideal approach for this?
So when I do it, most of my trades will be just trying to manage my deltas. So I do two types of trades. One, like say when I start building my monthly expiration, those will be the positions that I hold in my portfolio and trying to chip away some premium on it, right? Maybe do some covered calls, maybe do some call spreads, or maybe do a Aaron Condor or sell a strangle if I'm okay, comfortable to own the stock if it falls down, right? So those will be my primary trades that I'll do. Then I look at overall what's my delta or portfolio delta is, beta weighted, and then my most of my trades will be trying to manage that delta. So I don't look at the SPX support or resistance, but I look at it, oh, the market has fallen down a lot. Maybe a lot of my portfolio has increased a lot more in deltas, more than I'm comfortable with. Then I'll go and sell a call against, SPY or QQQ to reduce some of those deltas. So that's just me. I don't know if anyone else have a thoughts to share, because in terms of looking at support and resistance and then try to take a position. Most of mine are the delta hedging trades on these indexes.
Joe, most of your trades are buying the calendars and diagonals, or is it selling them?
Me?
Yeah,
Joe.
it is
Joe,
it's not a short trade, it's a long trade.
Okay.
The calendars is something that I've never been able to include a lot in my toolbox. That's one thing which I've been reading and know about it for years, but I have not done much on the calendar side.
Yeah, and it's all about adjusting it too when you get to a point of tolerance. And so there are good ways to adjust it.
So calendar is short the front month and long the back month, right?
Correct.
Okay.
So, and I know some of my positions when I'm trying to roll out and roll up, they become calendar trade because I've closed for this month and then I've rolled it to the next expiration and also changed my strike prices. But I think going in, I think I've hardly done any calendar trade as my opening trade. I don't think I've done that. That's something, and again, I've lived without it and it's working, so it's okay.
So Joe, when is the best time frame for calendars? Because most of my trades are short put, naked short puts or naked short strangles or short put spreads. I have some calendars, but my terms are usually very far out. I usually go like 2027. For your calendars work effectively, how far out do you usually go?
Once again, I'm talking about a double calendar.
Oh, double calendar, okay.
Yeah, so you're out the money on the call side, you're out the money on the put side, and you're using those deltas to make it a delta neutral trade. And so you will get a very, very wide area. But the most appealing thing about it is your risk to reward is in your favor.
And
I've
you're
got to try that.
putting those trades when the volatility is at a very low level, I take it.
So Sri, Dave, looks like we're gonna probably have a lot more in-depth discussion on this one.
Okay, sure,
So
sounds good.
let's
Thanks.
save it
I'll
for
shut
our
up.
breakout room because I don't know. I don't know. You guys are a lot more interested in this. I am, but I guess we have another 44 people. Some of them, so they may not be interested in this one. So hold on these deeper discussions for our breakout time. What's your opinion about ASML or KLAC? We will talk about it when I review the TSMC earnings. We'll know why a lot of these stocks are jumped. So I will go over that. All right. So coming back, what else happened in the markets this week? Barrage of headlines. Right, started with Venezuela. We also look at new sanctions, the protest happening on Iran, and then new sanctions we put on Iran. We also had like this Greenland military takeover. That discussion continued to happen. Investigation into Jay Powell. White House saying we should ban institutional investors from buying single family home. Freddie and Fannie buy $200 billion of mortgage bonds, 10-year cap on credit card. It's like so much news. I mean, and not unexpected given who we have in the White House. We'll see that that person always want to be in the news. There is a lot of stuff coming in. But the whole idea is, hey, this could distract ourselves from our investing journey. At best, I take this as a, you know what, these are the things, are the tempest in the teapot. Right? Eventually, markets still haven't moved much. And if you're looking at a really geopolitical issues, these starts to show up in energy prices, because that's one which is a global trade. And we haven't seen real energy prices going higher so far, despite all the geopolitical tensions, right? So we're looking at energy is kind of one of the lowest one over the past many years. So I'm not paying too much attention in terms of worrying lots of the stuff that we are hearing in the headlines. It does give me an opportunity. If you're trying to sell some premium, we'll see VIX spiked up 7%, 8% on the day. At that time, it's a good time to sell some premium. And I loved whole 2025 and all those tariff news, because that was a good time to sell some decent premium. Once those fears, they haven't completely disappeared, but once we knew that taco trade was in, all that option trade started to mint money, because the vol declined a lot. So this volatility does give you a chance to profit from it, or maybe sell a premium when the market is on your side. Other than that, not making too much of hasty decisions in terms of what we are hearing in the headlines. Over the next 15-20 years, we'll not even talk about these things. We'll forget about what happened in 2026. And who cares what happened in 2016? We are now 10 years, and we had that was a Trump's first term, right? And market was expecting Hillary Clinton to win. And if terms comes into picture, market was expecting a huge sell-off. What happened was completely other way around. And nobody bothers. I don't even think about what happened in 2016, except that I made a mistake. And that's where I forced myself to know I need to figure out how to stay in the market, and learned options and started doing options then. Because I made a mistake of getting worried by what happens if Trump, if Trump comes in, market will sell off. Whatever small portfolio I had, I sold, a chunk of my portfolio. I think I sold 20% of my portfolio. And that hit me hard, saying, gosh, I have to figure out how to reduce risk without selling it. That was my start of my option journey. But do I think about 2016 other than that? No, we'll forget about it. 10 years later, we won't even talk about all the headlines. But right now, vol will give us some opportunities, make use of that opportunity. What we also saw this week is inflation is moderating, like not yet 2%, but we are looking at 2.7, 2.6% going down and down. That means hopefully we will get another pay cut. Now the CME has fixed their website, so I could get the probabilities table. I know last week they've made some changes to the website, and that table had disappeared. But yesterday I checked it, it's back there. So now we are looking at market is expecting maybe another rate cut in maybe spring or summer. But I don't think we're gonna, at least market is not expecting any rate cut in the January meeting, right? Maybe we might get something on April. If the inflation stays where it is or even go further down, we have a better chances for maybe then Fed will be okay to cut the interest rate. And that will be good for the markets. A lot of stuff which is still, I think I talked about it last week or the week prior to that, I thought that maybe market is driven more by the increase in the multiples, but the study shows that it's all driven by earnings growth. So it does deserve where it trades right now. So I have to change my own opinion around it and make sure I still want to hold more deltas than what I thought I would want to hold in 2026.
Which study did you see which tells you
I
that?
share the charts, right, with the Goldman Sachs charts around 5-year,
Right.
2020 to
I
2020.
mean, okay, let's when we do predictive modeling, you can pick on a factor. So they picked on a factor called earnings and they say, okay, it's dictating that, but it's not necessarily the dominant factor. How do we know? We don't know.
I don't know. And that is why I'm not going too big, right? So the idea was, I thought in 2024, I thought, oh my gosh, 2023 was a great year. Maybe I should go with the lower deltas, right? And I went with the lower deltas than what I was in 2023. I made money, but I could have made a lot more money because that was, hey, it was a great year. 2025, I saw that AI trade is still happening and there's a lot of, good news coming out of it. I was with a little more deltas, went in and held more deltas than what I held in 2024. Turned out to be a great year. Again, I thought, hey, maybe we are too much too soon. But looking at the earnings and over a long period of a time, I think, pick any study, the market will tend to follow earnings. Now, there could be other stuff that will come in, we'll manage it.
Yeah,
But
but I think news flow is actually upsetting even the earnings being a factor. That's what
yeah,
I'm determining for
we'll
myself.
see if the earnings starts to come up and say, hey, we see corporates reducing their forecast for earnings, etc., we'll adjust. But I am less bear. I'm not bearish, but I'm little more bullish than I was, let's say, 4 or 5 weeks ago. After looking at the numbers saying in 2025, like out of a 17%, only 2% came from multiple expansion.
Well, in the
Everything else
last
came.
4 weeks, your CNN fear grade index has climbed to a high, so you missed it.
Well, fear and greed index is a good barometer for me to know when to step back and
Yeah,
when to lean in.
yeah,
Right.
yeah.
So we're looking at economic growth. That is still solid. Real GDP growth 3.8%, second quarter 4.3%. And estimates are pointing that in Q4, we're looking at 2% expansion. Consumer still spending. Despite all what Jamie Dimon has said, right? He's been saying like hurricane is coming, tsunami is coming, I think since 2021 or 2022. And but as a CEO, that's what he's paid to do. But look at his bank's results. Consumer are still
Vivek,
spending, right? Yeah, Sam.
this is BS. We people have to spend money. Prices go up. We have to buy them.
So I'll come to that. So if you look at all the big bank results that have come out, I think Citibank, Bank of America, JP Morgan, all of them have seen like six, and I don't know what sequence, but 6%, 7%, 8% growth in their loans. Now, on one side, you could say consumers are feeling optimist, so they're spending. On the other side, which Sam is trying to bring up a point, is saying, oh gosh, the prices are going high and consumers are borrowing it. And they're borrowing it more, they're putting everything on a credit card because they are not able to survive. We don't know what the reason is.
Or the buy now, pay later
Yeah,
way.
PNPL stuff also, right? We don't know what the reason is. But so far, consumers still spending. The end result is that the companies are still able to grow their revenues because they're still able to sell the stuff, right? Looking at earnings growth, S&P now is on track to deliver 10th consecutive quarter of year-over-year profit growth. Fourth quarter, we're looking at 8% increase. 2026, 15% earnings growth over 2025, with all 11 sectors expected to contribute. And coming to Mike's point, which is, hey, maybe these news could cause a change in future earning growth. Yeah, then we'll adjust it. But right now, with this expectation of 15% earnings growth, with broadening of economy, it's not just the tech sectors growing, but all other sectors expected to contribute. It's hard for me to become bearish. Right? We are seeing, backdrop for M&A activity, ongoing deregulation. All these are positive for the overall economy and earnings momentum. Larger tax refunds. We're expected to receive $100 to $150 billion in additional tax refunds. And that was not, that's part of OBBB. And the consumers will have more money in their pockets to spend. But consumer will spend if they are, a little more surety of the job. If they are unsure about the jobs, consumer will hold the spending. They'll basically save it. But if the job market, which has started to maybe stabilize, then yeah, those consumers will go out and spend it. Right. So jobless claims are now historically low. December drop in unemployment rate suggests that the labor market may be stabilizing.
I've noticed lots of calls from recruiters is starting January, so looks like it's the freeze is over.
Yeah, and so all these tailwinds and deregulation is yet to appear, and White House is okay to run the economy hot. That's why I have to change my own thesis around. Maybe I think I should at least keep the same deltas what I had in 2025, if not more.
Vivek,
Yeah.
I don't understand. When I was in China, they're saying people are spending money, just like you said, on credit card. But why can't they cut back? I mean,
China is a different market.
no, in the US, why can't they cut back?
Culture,
I mean,
cultural difference between
hey,
China and USA.
no, excuse me, I'm an American. My food bill has gone up 5 times in the past 6 years. 500, 600%. So, I mean, but I'm cheap like hell, so I could afford it. But why do people, if they can't afford it, I mean, excuse
Because
me.
they're not cheap. They want to enjoy themselves.
Yeah.
I enjoy
that's
myself
the
by
prevailing
saving money.
American ethos. American ethos is built around consumerism. When you can have a new car every year, they would rather do it.
Yep. And
That's the
people
prevailing
call me cheap because I've been still driving my decade-old car,
Exactly.
which I need to
Excuse me.
replace. It's not that I can't afford it. I just it runs fine. Why do I
Excuse
change
me.
it? But now it is at a
most of
stage
it-
where I need to replace it.
Yeah, that's why America has a debt.
Well, it's like the middle class or the upper middle class. They can afford more and more stuff, but then they don't stop. Why can't they say, excuse me, I am addicted. I told Vivek this about 3 years ago that I'm stuck on Amazon, like buying $35 of stuff. But the thing is, at least like today, I took out someone to go eat at a place. It cost $60. Then I said, well, yesterday I didn't bring a big bag to Costco and they didn't have any for sale. So that's where I saved the money to spend for today.
Okay, so Sam.
But what I'm saying is, why can't people just say no?
It's difficult. I mean, I see in my household, you and I, different generation, grew up with different ethos. I see my own kids. I'm like, guys, you're spending money like I won't spend it, and you don't make even you don't make any money. My elder one has started to earn. You don't even make that much money, but hey, they grew up in a different environment, and that's how America. It is what like Mike said. This is how the ethos of America are. And I guess they'll figure out their lives. But I'm different. I sometimes I still feel a pinch when I'll spend on something.
In the
My
GDP
kid
equation,
will not even think about twice or spending. Like,
right.
what?
So the GDP equation, GDP equals C, which is consumption plus I plus 2 other elements, right? Why is it that only for America that C is 70% of the entire GDP?
Our
Think about
consumerism
it
is
for a
70%
second.
GDP. All right, this is a discussion
not quite easy.
never gonna finish. But
Excuse me, GDP for China in 2016 was 50%.
What was C in there? C divided by G. What is 50% or lower? I think so.
a lot of GDP is coming from government spending, like maybe in
There you go. So
other
in
countries.
China and all, it's
Yeah.
more of government spending. It's more of direct investment.
But that's G. That's G. That's not C.
Right. That's what
Yeah.
I'm saying. So if G is the overwhelming portion of GDP, then C in China is much small proportion. Chinese are known to save and not consume.
Chinese are known to save. Indians are known to save.
No, China, I mean, because of that economy is in a funk because they can't make them to spend.
Well, because they don't get right now since 2021, people have been depressed there and they don't spend. Unlike the US,
Exactly.
they gave out these pandemic.
You said it that for 100 years it's been observed, it's in financial academia, that America is far more optimistic relative to Italy, Germany, any other capitalist markets, any other. So that's why the risk premium, there's a technical term called risk premium. You can look up. It's much lower in this country. For investing in a capital markets, in Italy, you require much more risk premium.
All right. Let's move on, because this is a never-ending discussion. We have it in our own household, and I think that's applied at country level. Oh, come on, how much are we spending? Why do we need so much? But I think this will continue. So other stuff we're looking at, the market leadership is broadening, right? And I think recently, if you look at CNBC was talking about it, IWM has beaten S&P 500 over the last 11 consecutive days, which is first time since 2008. And IWM, I mean, like S&P is all you call as a large cap driven by tech focused, like 40% of the companies are tech. The market cap comes from a tech focused companies, and whereas the IWM is much broader. So leadership is broadening, small and mid caps, value stock, international, and less we talk about materials and minerals like gold, silver, industrial, they are outperforming. So so-called 493, the rest of the max 7, or rest of the S&P 500 apart from max 7, now they are leading the markets. They all will benefit from Fed easing and improving economic outlook. Right? So breadth is there in the markets. Me personally, I will not be bearish. I will skip this. This was just running some numbers on, hey, going back 20, 30, 40 years, if you're in doubt in terms of, oh my God, Amazon hasn't performed this year, right? I'm looking at, this was, I think that's the end of December. So going back 1 year, Amazon only did 5.9%. This is only capital return, not including dividends. But if you look at 10-year CAGR on Amazon, it's 22%. Meta is 20% CAGR. Tesla hasn't performed in 2025. But if you held Tesla for 10 years, it's 40% CAGR. So when in doubt, zoom out. We get so much caught up into what happened this week, what happened this month, that we tend to miss out this big picture, right? Of making sure that we stay invested for a long time. If you have done nothing but just held S&P 500, it's been almost 12% CAGR for 15 years, 20 years. What else do we need? And of course, last 15 years, or last 10 years, look, NVIDIA's, all the gains came in over last 10 years, and a huge amount of gains. Like 70% CAGR. It's like doubling it after every, 15 months? Stuff like that. So when in doubt, zoom out. And we have surpassed all the pandemic, oil shocks, world wars, and whatnot. Elections, blue inviters, whether red inviters, doesn't really matter.
Vivek, if you compare the Russell 2000 and the SPX, you find that Russell 2000 is outbeating in all 1, 3 months, 6 months, 10 months, and 1 year time period.
Yeah, 1 year, like, I know IWM is 14.1. I mean, didn't show.
Instead of looking at the IWM, if you're looking at
look
the
at the
Russell
2000.
RUT and the SPX, you will see that change.
So what is your opinion about the forecast for IWM? In other words, what do you see unfolding for the small cap and micro cap over the next 6 months?
I don't even opine on 6 months.
Oh, okay. Because I think all these rallies which imply market broadening out are going to be very short-lived, because small caps are kind of the factor which would drive them up would be lowering of interest rates.
Yeah.
And that's not going to happen based on what you just said a few minutes ago. And, in general, the economy is so strong.
But inflation is coming down.
That has been the reason this guy preemptively has cut by 1.5% in the last 1.5 years.
Hey, we're gonna get a new Fed chair, man. You think that he's gonna appoint anyone as a Fed chair is not gonna cut interest rates?
Well, then we'll have trouble.
Yeah,
Because then the
we'll have a
bond
different
markets will
trouble.
be
It is the bond market will come back and shout.
The other way that you can look at it is over the longer time period, the Russell has not outbeaten the S&P 500 for an extended length of time. Now, if you take a ratio of the SPX versus the Russell, Russell is moving higher, and that momentum can carry forward into longer time period than what you can imagine.
Yeah, I hope it is. So the last time I saw that happening in the small cap rally mode was 2018. And that time was different from an interest rate perspective. But I could be wrong, but I don't expect a small cap rally to continue.
Yeah, and you're right, Sri. I'll just look at the number. RUT did 19.5% in 2025 and SPY did whatever 16%. Yep.
So in the long run, the Russell has outbeaten the S&P 500.
That is correct. In the very long run.
But yeah, depend
over a 20-year period,
long run,
right?
not in last 15 years.
Yeah, exactly. There we go.
Not in last 15.
So in the normal business cycle times, which basically completely disappeared starting 2012, I believe. 2013, starting 2013, I've never seen financial markets like go up in a secular single line upstairs, And that's what is different about this investment marketplace, I think. I don't think small caps has a chance in this new marketplace.
Okay, time will tell.
Yeah. Even if let's say small cap individual companies I'm worried about these indexes and all that stuff. So I used to, still hold IWM in my portfolio, but I've stopped adding more capital to IWM because, and again, someone can correct me and help me in my understanding. My understanding was because Russell or IWM, etc. The moment company becomes bigger, they basically, those companies move out from Russell and move to S&P and large one. Is that even right? Is that a right assumption? I've not looked at what's the composition, what's the biggest companies on IWM. Maybe I could just check. My idea was that, hey, you should invest in smaller companies so that you can ride it when they become big companies. You can get all that growth, which is right way to invest, is make sure you get all those growth. But if you're investing in an ETF, then by the time those individual companies actually become big, they moved out of ETF. Yeah, I don't see any big companies in here. And once maybe I had that realization, I said, then I would not want to invest in IWM because let's say I identified a good small cap company, great business, good growth. And if that business becomes big, I invest in that, become big, and that moves out of IWM, then I did not really benefit in it. So if you want to, and I thought if I really want to do benefit from identify and invest in a small cap, then I have to do an individual company so that I can stay with it while the company has grown to become bigger and not go via the ETF route of IWM. So that's what I thought. And I don't, yeah. So I guess, let's say one of these companies, right? Pick up any company. Let's say pick up Nextpower, AeroVironment that's been in use. It becomes really big. It'll move out of IWM. Then I'll miss out all the growth, future growth in this particular company. So after that, once I realized maybe then it's not a right way to invest in a smaller growing businesses. ETF may not be the right way. You guys helped me and correct my understanding. And after that, I stopped investing in IWM. Maybe I should just pick up AeroVironment, whatever, AeroVironment as an individual company rather than getting exposure through IWM. Anyway, little distraction. Any thoughts? All right, you guys still with me? Complete silence, radio. Suddenly radio silence. Okay, sector-wise, how did we do sector-wise? Nothing bad. S&P is still close to 1.5%. We are 2 weeks in it. Nothing much to share right now. Fear and greed index is moving on to the greed side. So again, it doesn't mean that the market is going to crash. It just tells us how the rest of the market is positioned based on those 7 factors that CNN tracks and comes up with this particular barometer. The way I've used this barometer is just to make sure, hey, for short term, do I want to now take a bullish position right now? Maybe not. I'll not go too bullish right now in terms, because right now the market is hot. Everyone else is feeling greedy, so I want to step back. I want to go in the market when everyone is feeling distracted, just has given up on the market when we are in the fear and extreme fear zone. That's what I would want to increase my deltas more, or maybe buy some of, add some more bullish trades. I also found some crypto freed and gear of greed and fear index. We are sitting at a neutral right now. And it's because nothing much happening around the crypto side. We were supposed to get clarity yet, and we'll talk about it when we got on the crypto. Didn't happen much over there.
Vivek, if you're interested in the big companies in the Russell 2000, SATS, EchoStar Corporation, Bloom Energy, CRDO, Credo Technologies, KTOS, KTOS,
Yeah.
AVAV. Those are the ones that
Yeah,
are
I mean, those are the top ones, right? It shows the weightage, and these are the top ones in IWM. So again, I think the same part is if you really want to invest in the whole idea, and I do see that the study shows that over a long period of a time, smaller companies outperform the larger companies. Like if you bought a smaller market cap company, good business, and let's say invested $100 in that and a large cap, over next 20 years, the smaller cap will outperform it. And that was my thesis behind holding positions in IWM is it has a smaller cap companies, it will outperform. But once I realized that the companies have started moving out from the moment the companies become big, it moves out from IWM. Then I realized, then it is not actually serving my thesis, because the moment companies start to grow and start to grow big, IWM is not, it doesn't enjoy from the growth of that because it is moved out of IWM.
Yeah, but that administrator, the custodian of the manager of IWM, it's his job to continuously make sure that it's got the capitalization value and so on. And so they rebalance. So while one goes out, another stock comes in.
Yeah, but the idea is before it's like
the thesis in financial academia is that these smaller companies have whatever characteristics which make them get returns which offset your large cap moves. So that's why they advocate it.
Yeah, but the idea is it's like you're investing in Amazon and the Googles of the world during first 5 years of their lifetime, because once they become bigger, where they become market leaders and then they can grow much bigger, they're out of IWM by that time. That's my concern. Hey, yeah, you enjoyed the growth from when it was like from a first grade, kid is from first grade all the way to middle school. Now when he starts to become more talented, shows his talents of of either a
Right.
the
The reason is there are the zig and zags of the moves in the small cap names and the large cap names that are meant to offset each other. And the thesis is once they become that big, then the offsetting move is not enough. So the holding of IWM is for that purpose.
Okay, you're talking about the offsetting. That's a different. That's I think a different thesis of investing is I want to make sure I have something to balance if my large cap is not moving, and these basically zing. If one zigs, other zags, I understand. But if you are trying to, my whole point was I was trying to benefit from investing in a smaller companies earlier so that I can stay with them and grow with them, which I realized that IWM is not a vehicle for me for that purpose.
Right.
Because they just take out the companies that start to grow out of IWM. I still hold IWM. What else? There was a chart around hedge fund performance in terms of 2025 and how they returned. Looks like hedge fund they are back to making money.
Of course, everybody was making money last year.
We were like 50%, 45%, whatnot.
Which is why the banks, big banks, JP Morgan results are so great. The trading revenues have gone through the roof.
Yeah.
Trading revenues means that they have a sell side trade desk which is selling to all these people like hedge funds who are buying from them stocks and bonds and swaps and all.
The worst were the multi-strategy hedge funds. Like max is 30%. Then we got a macro hedge funds. And like some of them even grossly underperformed S&P.
Wow, macro made 37%.
Bridgewater Asia. So non-US has done much better. Bridgewater is still doing much better. Again, I think many of them are because they are non-US. But anyway, so I was just trying to look at, hey, how did we do? I feel much better. What else? Stocks buys and sells. Nothing much. I had a covered call on Ford. Let it be a sign. I told you my thesis on Ford was I wanted to spread my bets on EV. So I had a GM and Ford. Once both the CEOs said they're basically pulling back from the EV side. I said, okay, I don't want to be associated with these companies anymore. And I've been selling cover calls over past few months. Finally, half my position is, I think it's a 3 tranches. So second tranche is now gone this week. If 20th Feb also get assigned, I'll be out of 4. And I parked the cash in ICSH. After last week, Mike told that, hey, it's okay to hold ICSH. I'm still doubtful. Maybe I'll switch to SGov. But for now, I just parked it in ICSH and wait for right opportunity to add more capital or do more bullish trade. Until then, I'll park it there. Earnings next week. Only thing that's interesting for me would be Netflix. We still have a lot of financial companies reporting earnings. We got a Bancorp, KeyBank, Interactive Brokers, brokerage firm, Ally Bank, Charles Schwab, Intel. A lot of Intel is a lot more in news, and the stock, or at least in the near term, like last 1 year, has done really well. Want to see what the new CEO Lip Bhutan has to say about the foundry business. But yeah, a lot of banks. Anything else you guys are interested in next week?
Next week, okay. Is there any AI chip stock coming out? No.
Otherwise, I would have spoken. No AI, no chips, no mega tech, not yet. That generally is in the 3rd week.
Right. But I think Intuitive Surgical interests me a lot. However, Intuitive has already kind of come down. Maybe they pre-announced or something. But it's a good growth company.
Charles Schwab and CACI.
CACI. What is that? I've never I don't think I've looked at this CACI.
Kaki, I worked with this company's product 20 years ago. So basically, they do network analysis software. So they have a lot of customers in the defense world.
Hmm. Oh, it's a tech company.
They morphed into digital cyber security. Used to be more of a pure single analytic software.
Okay. I mean, stock has done well. What's so more? It's like a more government work. I mean, the revenue growth is pretty. Seems to be a mature company. But has been IPO maybe in the markets for last 10 years only, not more than that. See, I say 10%, 10, 12%, 14% revenue growth. If you look at it last few years, it's like a single digit, low teens to single digit revenue growth. But does make some decent, okay, not decent. Doesn't seem to be like a software company, more like a consulting company.
Right.
Okay. Yeah, it's more of a consulting business, but that's why the margins are pressured. If you look at it, these are like trading at a single digit operating and profit margin, but good cash flow margin. So really looks like a pretty steady business, mature business growing at a low teens, but able to generate enough cash flow even though the margins are less. So don't expect too much of a growth in this, but they may be doing some buybacks or giving dividends because it looks like there's not much opportunity to, if they're not growing their revenue, what are they doing with their cash flows? Where do I see their buybacks or dividends? Let me see if there's a ratio, so it'll show us something. Buyback dilution. Yeah, so they're buying back a little bit of they're buying back some shares, not enough, but are they paying dividend? Let's see, do we have a dividend? No, they don't pay dividend. They do buy back some shares. So probably not too, I'm not interested in this one. I think there are better companies on the tech side than this, but it's a pretty steady business. All right, so earnings. This week we had Taiwan Semiconductor, and I think there was a question on what is happening to KLAC, Lam Research, and I think all others. It's all because what TSM has to say. Right, so TSM reported results. I will come back to this later on, but I mean, everything looks good in their results. Revenue is up 20%. These are Taiwanese dollars, so up more than trillion. It was a beat on revenue, beat on EPS, operating cash flow up 17%, net income up 40%. And they're becoming better in terms of managing the margins, even though they were, and because some of those fabs that they had recently started, they're now producing, not producing, but they are actually now at a stage where they are in a, what do you call, full, running at a full capacity, and hence the margins are becoming better. Free cash flow is up 43%. Guidance, their revenue expecting between 34 to 36. They increase their guidance for gross margins, increase their guidance for operating profit margin. This is what caused the rally.
Yeah, and how do you, which source do you follow for the market moving news? For instance, what you just highlighted is exactly what they said, 37% growth guidance increase, right? I'm wondering what places you follow to get the news quickly as to what's moving the
So
stock.
I just went to its a earning release, and I looked at over there, and the other thing is the earnings transcript, and I know, okay, these are how the distribution is.
Have
And
you
now
guys
it moved the market. I thought it moved the market because they talked about a huge increase in capex.
Right. And that actually also influenced the
Other
kind of
chips.
sister stocks like Nvidia and all. So I'm trying to figure out like what news source, what websites you read. Like, do you read Seeking Alpha or some other website to get the news quickly on what's moving these kind of stocks?
No, in some cases, let's say, so there are some accounts. So there is something called Walter Bloomberg who will post. Basically, the guy posts the Bloomberg news. If you want to get the news quickly and not want to pay whatever $2,000, $3,000 per month, there is an account called Walter Bloomberg. Walter Bloomberg, right? So he will post it. And even Bloomberg hosts have talked about this account. They say we don't know who this person is, but he posts a lot of news, very pretty the latest news. So I do follow him. I mean, it's a good source to know what's happening. But these numbers, I'll go through the earnings release and the transcripts. This came from the deck. So the capex increase. So they spent almost $41 billion in 25, and the market was estimating that they were gonna spend $48 billion in 2026, but they came up with an estimate. The management told they're gonna spend $52 to $56 billion. So that means if TSMC, which is a fab, gonna spend $56 billion, it means they're gonna buy the equipment, and then the supplier of all those equipment companies, their stocks went higher. Look at what happened to ASML. ASML jumped more percent than TSMC after the TSMC earnings were out. And I was looking at what the heck, why is ASML is up like 7 or 8%? TSMC was up 5%. And I would guess the same was the case with Lam Research, KLSE,
AMAT.
Applied Material, AMAT, because these all provide the tools and the equipments that a fabrication company, the chip fabrication companies will need to create those chips. And that's what caused all the whole SMH, if you look at
SOX, SOX.
or SOX or I'll then focus on SMH. No, it went high because of TSMC, right? And they also announced $6 dividend. What I look at is it'll go a little longer, and look at their CAGR over quarter on quarter. Forget quarter on quarter. There is a number, it's there, but I focus on year over year, 3-year CAGR, 5-year CAGR. Man, this company is still great. They've been executing like crazy, and maybe these 5 years. I mean, we got a chat GPT in 2023, 2020, end of 2022. Maybe 3 years driven by it, but 5-year CAGR, I mean, all numbers look good. Revenue increasing 24%, gross profit up 27%, net income is up 30% CAGR over 5
Did you
years.
get this data for the last 4 quarters of
What do you have? I mean,
stock analysis or?
yeah.
Okay.
So stock analysis, you can get the quarterly data, right? So anyway, that was the reason why we saw all KLSE and everything else, all the stocks going up. But not only this, so when I looked into its the earnings transcript, few things that I mean, they talked about 2 nanometer was a progress. They also pulled in. I'm not going to read through all of them, but some few things is they're seeing a good ramp up on their N2, which is 2 nanometer fab. Now they're moving into the ramp up, means moving into the full production. They're also pulled in the Arizona the Arizona plant. So I think the number 2 plant was supposed to, hold on, let me pull up. I don't think I tweeted that, but we're talking about TSMC, right? Hold on, just bear with me. Let me pull that data if I have. I think, let me pull it. Okay. So they pull in, yeah. Yeah, so Arizona Fab 2, it was supposed to be at the end of 2028, which is 3 nanometer. They've now moved that forward to second half of 2027. Third fab, they already started the construction. Fourth fab, there's already, getting the permits. And they've already committed for doing so many fabs. What has changed? Japan fab is now in volume production. It's been there since 2.3. And on Taiwan, 2 nanometer, both in both of their tech park, they entered high volume with a good yield. So basically all things looking good for TSMC, right? So we talked about a capacity expansion. We talked about Arizona, talked about international. I think the market was a lot more concerned about, is AI, is there really a business on AI? Or is there, how much, or is there a lot more fluff on AI? So he did talk about the fact that he's concerned, not concerned, but he says, I'm also a little cautious because I'm spending 50, whatever, the 52 to 56 billion dollars. So I myself was a lot concerned in terms of, hey, are we getting, is this AI is for real or not? So the CEO, CC Wei, he said, I talked to customers. I talked to customers of customers. Then I came back satisfied that these customers are really benefiting from the tailwinds of AI. So they raised their 5-year forecast of AI accelerator revenue to approach mid to high 50s through 2029. Earlier, they had given to 50% CAGR till 2029, and this was, I think, starting from 2024 to 2029. Now they raised it to mid to high 50%. Overall long-term CAGR for the company is 25% in US dollar terms. The growth, the revenue growth, growing at a 25% CAGR, pretty decent business, right? Capacity remains really very, very tight. And if you followed this company or heard the CEO, every quarter he'll say, we are working very hard. It's very tight. We have too much of a demand and we cannot, supply what all our customers need. We cannot supply them the chips. There are specific questions asked by analysts on how about the energy? All these data centers, they're talking about, increasing the capacity. Isn't the energy bottleneck? So CCV had to say that what he hears from his hyperscalers is that they figured out the energy, the wafer is the bottleneck. So he says, my marching orders are go and produce more because they are ready to consume for next 2 to 3 years. So he says, all the plans that we're building now, because our customers are thinking 3 years ahead and then telling us what they need. Because for us to even create the chips, it will easily 2 to 3 years long cycle period. You can't just putting up a fab is not easy.
But did he say that, where did he say that energy is not as important as availability of the chips?
No. So he says hyperscalers have told him that they have figured out on the energy side, they'll figure out.
Oh,
but
really?
right now he is the bottleneck for them. The availability of the chips is a bottleneck. So don't worry about energy. You go and continue to build the capacity.
You heard the earnings call? That's where it was? Is it on the earnings call or where?
It's on the earnings call. So if you look into, I don't know if I actually can.
That's surprising because what I'm hearing now is in the last 2 weeks that power energy is the big bottleneck.
Yeah, and if I were a hyperscaler customer and I want a TSMC to work, that's exactly what I'm gonna say. Right? I don't want TSMC to tell, I think we have a power problem, and as a TSMC, CEO said, they have got other problems that they have to deal with. We can go low on our capex.
Right.
Right? That's how I read it. But I'm all saying what he said. Okay, longevity of demand, despite the concern on AI bubble, his discussion with hyperscaler led him to believe that AI megatrend is fundamental. It is here to stay. There were concerns from some analysts around that semiconductor is a cyclical play. Generally, it is 2 to 3 years of cycle. And we have seen the boom and bust in the past also. The question was, has AI extended the length of this cycle and maybe we're going to get into the bust mode pretty soon? Probably, but we don't know how long this cycle will be. So that's, I think, a mystery for everyone, is how long this cyclical business in the past has now become a secular business with secular tailwinds over the last 3 years. Will it continue to be like that, or will it revert back to its cyclical nature? Only time will tell. That depends on how much of a AI tailwinds continue to be.
So the parallel for this would be 1995 to 2000 timeframe, because the semi stocks, the equipment stocks like AMAT and all, broke out all of a sudden in 96, 95, and it kept on going, but with, of course, drawdown. So there's never going to be a straight line up. There'll be drawdown.
Yeah.
It'll stay for at least a couple of years, I think, from now.
And semiconductor is notoriously, I mean, it's known for its cyclical nature. Just that maybe this year, in this time, just that the up cycle the length has been extended. Yeah. And if you really follow the management, they generally are conservative in their guidance. So when they're saying 25% in US dollar, we're gonna grow for the next, long term, we're looking at 25%. And with the conservativeness that I've known CCV to be, I feel, okay to hold this company in portfolio. So that's TSM. Good business, a company that we cannot live without. All right, last topic, crypto. Cryptos all went higher because I think we were looking at a Clarity Act, maybe get passed, which it did not. But let's go through some of the other news. So Bitcoin is trading at 95. Last week it was like 88, but now it is back at 95. We'll see how long this continues. It's a long-term play anyway. Doesn't matter week to week what happens. Bitmine Immersion, BMNR. Any BMNR holders here? Tom Lee fans? This BMNR was like a kind of a retail meme stock. Anyway, so they invested $200 million in Mr. Beast company. And guys, you're supposed to be Ethereum treasury company, DAT company. What are you doing by taking an equity stake in a Mr. Beast? So I think it was Friday. Yesterday they had a shareholder meeting or an annual meeting. It was live streamed. So he did explain. Tom Lee explained the rationale behind his investment in BMNR. One is obviously Mr. Beast is the most successful content creator world has ever seen. 450 million subscribers, 5 billion monthly views. He's on Amazon Prime, he's on YouTube, he's all over the place. And the new generation, millennials, alpha, Gen Z, they follow him. And that is a generation which will be a big adopter of the crypto products. So you want to be with them. Number two is Mr. Beast probably looking to create a financial services platform. And then you want to take a stake in the company, make sure you push your agenda of building those DeFi products on Ethereum, right? And of course, with a little diversification on the brand side is, so far, Bitmine Immersion is only known as digital asset treasury company. With stake in this, it probably expanding into some other areas also. I'm not touching this company, but I know this is a company followed by a lot of retail investors. So thought I'll bring it up.
Did they say where the money, so they invested in Mr. Beast, but does it actually say how the money is being spent?
No, so basically they taken an equity position. So Mr. Beast had gone for a new funding round.
That's
and
why.
They participated in that funding round. Chamath Social Capital has also invested in Mr. Beast. I don't know if in the latest funding round, but he did back up Mr. Beast in his initial funding round. So basically, they did a new funding round and Bitmine Immersion participated in it.
That's exciting, actually. Mr. Beast actually announced too that I think for the Super Bowl, he's going to be helping Salesforce do their ad. So he's partnering a lot with a lot of corporate investors right now as well. So I didn't realize he was doing a funding round. That's very exciting. Thank you.
Cool. We talked about Bitcoin, back to 95,000. Ethereum did another beep, the basically block. We can skip this. Too technical. SEC did a crackdown on. This is all over the places. And there is one ad which is like, I'm tired of that ad which just talks about, it's all AI generated ad, because when you look at the characters, those are the AI generated ads, which is how to find the next Solana and all that stuff, right? Before Solana becomes Solana, or before Bitcoin become Bitcoin. And I'm sure there are a lot of people who will fall in for those scams. So SEC probably now looking at these platforms which generate these investment tips and just fleece people out of their money.
Vivek.
Yeah.
You remember 5 years ago, it looked like a live video of the founder of CRM, and they said, give us so much and we'll give you so much.
Yeah. So not, I think CRM, I know Chamath Palihapitiya, he was in a conference, and that scam used to be you send me 1 Bitcoin and we'll double and send it to you.
No, it wasn't 1 bit. Send us so much money and we'll give you so much. Sorry, it wasn't CRM. It was I don't know. I guess the 5th largest traded Bitcoin, but it looked like he was live.
Yeah. So again, if anyone is telling you send me $1, I'll give you 2, these are all scams. And the scams have been there ever since money has been around, So, but it's become more and more sophisticated by use of technology. In fact, I remember what was it, 4 or 5 years ago, or 6 years ago, maybe there was a conference in which a lot of these VCs were there, and Chamath Palihapitiya was like, "You send me whatever," and again, it was completely deep fake, right? In a conference, he's talking about whatever amount crypto you send me, I will double it and send it back to you. And I'm looking, I'm like, hey, he's a reputed guy. This is a VC who's building something. Yeah, I would be willing to send it. I was in the kitchen making lunch, and maybe I'll look at it later, right? And I did, that thought did go in my mind at that point. It was so real. And it had a QR code which you can scan it and send it. So I'm sure a lot of people will fall for it.
And I feel the United States doesn't do a good enough job of restraining these kind of loud mouths. I think that we need more regulation on that. That's why a lot of the initial investors like me in my early investing lifetime, when there was no social media, just radio and all, you listen to these people and you do things, and then nobody's there to actually bail you out.
Yeah,
I'm pretty sad about America.
I mean, again, the idea is where you want to have a parental control or where you don't want to have. There are 2 sides of this discussion. I don't want a parental control. I'm an adult. Let me do what I want to. If I want to gamble my money, let me be it. But then when you lose money, and then we have seen in the US also, when people lose money, say, oh, government should have done this. I don't know where to put the line in terms of government should do this or not this.
They should not allow to brag about it and kind of be using the media to publicize them. So they should be like hedge funds where they basically solicit certain people in closed rooms.
No, but these guys are not telling you to buy. I mean, they know how to protect themselves. There are people who come on CNBC and said, I bought the stock and sold the stock. Why not Chamath can tell you the same thing on Twitter? Skamath or Chamath. I don't think Chamath is not a scam artist, but he made his investments. If I blindly followed on his investments and, all those A, B, C, D SPACs and lost money, shame on me. Not
No,
shame.
I disagree. I agree with Jose. And I think this Chamath guy, it's one thing to make money on your own quietly, but if you kind of do what's called front running, in the sense he will say, oh, I've done this, and he is exhorting others to do it, then he's like, leading the pack. Anyway, that's
I don't know, guys. If you look at the history of SPACs, you know what. The moment he created a SPAC, he made his money.
yeah. So
Right. So all those SPAC promoters, they made their money once they decided to take on a SPAC because they used to get all those 25%. And I mean, I reviewed the whole SPAC in one full presentation of before you get into SPAC, understand these things. Right. And if you lost money, you lost money. Virgin Galactic, right? And many of the SPACs have invested in a company, it's actually gone down to zero because he made his money the moment he invested in the company. Doesn't really care what the business was. And that was his incentive. As long as you understand his incentive,
but most people don't see. That's the problem.
Twice, why should I invest in it? I also invested and lost some money because I did not understand how the SPAC promoters make money. Only after I realized when they make money, I thought, okay, there is no incentive to find the best companies in the world. You made your money the moment you invested. So it is what it is. But nowadays, these scams are becoming a lot more sophisticated.
You remember you protected me again when they said you could get it at these investments at what was it called, angel investing prices, and then you said don't do it, those guys just want, the angel investors want out, so then you stick your money there and caught up in it.
Yeah, I mean, I wouldn't say I protect anyone. You acted on what I was discussing and made your own decision. So kudos to you, Sam, that you resisted the temptation of trying to, hey, you get in early and you made a lot of money. Right? So kudos to you. Not everyone is able to do it. Angel investing sounds so sexy, looks so great on a resume. And because I also go and as a judge on a startup paging, a lot of discussion on angel investing and all that stuff. I said, dude, it's my own money. And I'm not going to invest until I have 50 companies to invest in, or at least 25 companies to invest in, because it's at this point of time, it's all spray and pray. But people invest in angel investing without even knowing how to analyze the business because it looks great on the resume.
There are people who will take advantage of others' naivety. The number of companies that are being established on a regular basis and the ones that go into the IPO, a lot of them fail miserably. Yeah. And you are putting your money into those things. Stay away from that. I did not get involved with the SPAC altogether.
Yeah, it's a quick money. Everyone wants to make quick money. And the last topic on the crypto is the Clarity Act is now muddied. And this was a tweet which basically gutted the bill. So Senate was supposed to vote on that. And then they say, okay, hold on, we'll wait. Because there are some provisions that were added into the bill, which was again the current incumbent banks are just trying to protect their skin. And they want to make sure that the stable coin, the companies who are promoting stable coins, they are not able to offer interest to the holders of stable coin. So there are few issues which Brian Armstrong listed in this tweet. A de facto ban on tokenized equities. DeFi prohibitions means it cannot be decentralized. You need to have your KYC done. So it means you don't have any privacy in that. They gave more authority to SEC, so eroding the authority of CFTC, and they killed the rewards on stable coins, allowing banks to ban their competition. Because banks know that if through this act, if stablecoin issuers are allowed to share the rewards with the owners of stablecoin, they will see, and that's what the bank has told, that you're gonna see the flight of deposits from the bank onto these stablecoin issuers. And then if the deposits of the banks fly away, if that dwindle, banks won't be able to make or offer loans to industries or to businesses. So that's what they are telling the lawmakers. It is going to result in the collapse of our loan economy, and it's going to be very bad for the economy. Don't allow the stablecoin issuers to pay rewards.
Makes sense, a lot of sense, because
On
I've
the
worked with
other,
these
hey, a
projects.
lot of sense that you compete for it. On the other hand, if I invest my money with a stable coin issuer, they're gonna pay me 3%, 4% return. Whereas banks paid me diddly 0.01%.
Right, but the point is that the whole financial system is essentially kind of like being underpinned by these large banks, and they have very comprehensive risk management practices wherein they have to guard against having enough capital to support the loans, etc. But Coinbase and all these people who are bringing in these things called crypto, which is sloshing around and actually yanking at the banking deposit, they have, so Coinbase is not worried about risk management. It's like FTX. If it goes under, it's going to suck out the whole RAM. But banks don't want to go under. They have done things for 100 years. JP Morgan doesn't want to do this.
And banks still went under in 2008, taking the risk which they should not have taken. In any case, I think it's again the question of should consumers, why are you, why, I think the concern from Brian Armstrong and the other, I think on the crypto side is, why are you banning a better product coming into the market? Because now you suspect that the consumers will take money from banks.
It's
Let
not a
bank give
bad product.
4%, figure out how they want to make money. It's like a protectionism for banks. That's their concern.
It's not more issues.
Anyway, so it has gone back to discussion, and we'll see what happens. So the Bitcoin went up under the assumption that we're gonna get this clarity bill signed. Now, I think it's anybody's guess whether it will happen this year or not. We don't know. Cynthia Lemons and I think Senator Gillibrand, these were the two main lawmakers behind this. So she did put, hey, we go back to the desk, and yeah, Gillibrand and they started creating this whole framework. Now go back and see what amendments need to be made. But it's always the case with that, an incumbent would fight with the last drop of blood to try to avoid competition. Same way, like I think the horse carriage union for the introduction of automobiles.
No. There's a lot more to it. There's many
I
dimensions.
understand. So I understand the way our banking system and our economy is depending on banking system. Now we are making it more protected, and we'll always be in the situation, right?
No. It's not more. All I would say is, because I worked in risk management at Bank of America as senior VP, the risk management practices at any of these newfangled things called FTX and all are non-existent. And because these are by their very nature are linked to the fiat currency systems, which is USD, they're going to cause problems. And so what I would say is, hey, Mr. Armstrong, show us your risk management strategy, how it jives with, how it aligns with the JP Morgan risk management practices.
Okay. So, all right. So I'll come back to this topic. We're done for today. I'll open up the breakout rooms, and then I'll have another question for you, Mike, which is we're talking about the reason why banks need to have all these risk management practices right now, and not all these, but why the banks are so much a risk is because of fractional banking also, right? Now, if you look at, I think there's in Wyoming, under the Charter of Wyoming, there was an application granted for a bank which will not, there will be no fractional banking, which will be 100% backed by the assets. You don't, and the requests are still denied because of the lobbying from these banks. If it is all 100% backed by the assets, then what's the risk there? Whereas our current bank works on a fractional banking, and then you need to have all these issues. We are having all these issues because you have $1 in asset and you loan out $10.
So fractional banking stuff is not as kind of relevant in risk management today as is the fact that you have a lot more leverage things being in the portfolio. For example, you have mortgage loan exposures, you have commercial loan exposures, you have these options book exposure, etc. So the bank, for when it does its risk management, needs to compute the actual volatility of all these beasts and how they link together, and then apportion at least 10% of the total to capital at risk. And so if Bank of America has 2.4 trillion in exposures of mortgages and blah blah etc., it needs to keep aside $240 billion in capital. The point is that none of these places like FTX and all even understand, and even you and I probably don't do that. I mean, I've been guilty of it. In your personal portfolio, have you ever computed value at risk?
No,
That
you asked me earlier also. I
so
said
the
no.
key thesis is, the point is, if you know your value at risk and you see that it is within a boundary, like say whatever 3% on a 1 day VAR, then you are confident that you will not exceed that capital at risk. Otherwise, imagine the world's banks, which are governed by these Basel risk standards, they all did a huge amount of leverage and they drained the whole capital out. It'll be like your margin call scenario in movies and so on. So I think that's what actually undid FTX. You know the FTX story, right? What
No,
happened there? $8
no,
billion went completely gone.
no. I know what one did FTS is was, and it started from very, I would say, unassumed reporting from one of our Coindex reporters.
No, what I'm saying is FTX, the reason it blew up was because it did not have this whole concept of managing all its risk exposures, which means it wasn't on a daily basis looking at all the things inside its book and how they're moving against its, and therefore computing a value at risk measure and seeing that it's behaving itself. So he had huge amount of VAR increase on the last 2 3 days of that other guy, Chinese guy who declined to back him
Yes,
and so on. And
see.
then all of a sudden his VAR went through the roof, and because of that the whole thing blew up.
No,
So diligent risk management says every day you monitor your VAR, and if you see it growing, then you do something to, just like you guys are liquidated by your brokerage.
yeah.
What's happening there? That's exactly the same thing happening.
So FTX, they were running their accounting on Intuit QuickBooks Online and on Excel sheets. So forget about VAR. So that
That's
wasn't
what I'm
even a
saying. So,
business.
so all these newfangled people, crypto and whoever's doing crypto, they have no concept of that. But unfortunately, they are hooked to our freaking USD system, and they're gonna bring that USD system down eventually, just like FTX did.
I don't think FTS brought on USD. So
No,
that
it
was
was
stupid.
fortunately because it was very small. 8 billion is nothing in 24 trillion of
Yeah.
US.
And again, by the way, if FTS was not liquidated, they would have been a very profitable company
Because
by
of
now.
Anthropic India.
Anthropic, yes.
Vivek, can you comment on Chinese EVs coming through Canada? I think that's pretty cool. Thank you for getting me invested in Chinese EVs. So should I just go into BYD?
I don't know. You know that I have position in BYD, Neo, and Xpeng.
No,
Now,
I don't know that. But you got me into two other EVs. One is losing money, and then the other one is earning money, so it's breaking even. But so I mean, now that China's gonna, I mean, I'm glad. Sorry, it doesn't have to be nationalist, but Trump I really dislike, and I'm glad Canada's standing on its own 2 feet. So would you invest in BYD is the most stable EV company in the world.
yeah, so I don't know about with respect to Canada, because there was another statement saying that we will not allow these Chinese EVs to enter US, and hey, Canada is not doing the right. US is a much bigger trading partner, so they should focus here. But anyway, I think I'm seeing a lot of these Chinese EVs expanding their global footprints because there is a lot more competition in China. Yesterday I was reading, I think Financial Times or Wall Street Journal somewhere. 116 new EV models are planned to be introduced in China in 2026. 116. And here, I think except the Tesla 3 models, we have not got any new model for the last 20 years. Like, come on. Chinese market is so competitive that all these companies are now going out.
I have a question regarding like Michael Berry.
Yeah, go ahead. Yeah, Marcus, go ahead with your question.
Uh, yeah, sorry. Yeah, my connection is very unstable. But yeah, so basically, can you comment on Michael Berry shorting NVIDIA and other AI companies? And
So
yeah.
Michael Burry had shorted NVIDIA and also the Palantir. Right? There were the two companies that he long back he took a short positions in, I think via options, and we don't know, he might have covered his, who knows. We'll get, now he also liquidated his hedge funds, so we'll never know. But Palantir has been overvalued. I've talked about it ever since it crossed $65 for me. Now it is trading at $170. Right. So I have no, I mean, I'm not surprised that he shorted it. Right.
Can I make a comment? I think Barry's a hack now. I mean, it doesn't matter. It's just like Kathy Wood. Who cares?
Yeah.
You know, they're professional investors. We can't do what they do.
No, I mean, but people do care about the folks who have made money once, it made a big money, maybe made it only once. After that, if you look at a Michael Burry, he's been losing money on most of his bets. But people still go back to think about Big Shot and the thing he did in 2008.
Right.
And
So
we assume that, oh my God, he's going to still be the same guy. Who knows? I mean, he closed
so
his
he
bets.
had to. You know the story of how he got his such a big bet to succeed.
Yeah, we watched the
Basically,
movie.
it was mortgage loans. So in this, when you have these things called mortgage loans, you can actually dive deep in detail into individual exposures. And in that year 2006, all of these players could actually go and see very clearly that this thing is going to explode implode. And so he specifically went to Goldman Sachs and asked them to create a over-the-counter ISDA contract for him to take such a large size position. And even then, it was moving against him. So
Yeah.
the point is like, unless you have kind of very clear, visibility into the thing being imploding, you cannot take such a $1 billion bet. No way in hell. These people.
And he was down a lot in his position, right? His own investors were like pulling money, saying, "Are you crazy?"
So for us to extrapolate from his one success in mortgage loan exposure bet to something called NVIDIA and all is completely untenable. Doesn't make sense.
Mike.
NVIDIA market is totally different. It's a stock market. It's not a bond market.
I was working in the industry 2005 and 2006, and well, I didn't know how to look at back then. Golden West, I think it was called.
Yeah.
It got bought out, and then
that was after the implosion.
No, it wasn't. It was during the. It was 2006. It got bought out so the owners got out of the business.
Okay.
And then the implosion was 2008. I don't care. They say 2007, but it was after Lehman.
Right. No, so you're saying you could not look into those detailed mortgage exposure books? Well, the point is that I think they could. I wasn't able to, but I think that's how these people were so confident. Their implied information coefficient for their bet was like 100%, that they could take such line size positions. Otherwise, no way in hell you can take a $1 billion unless you have very explicit insider information.
Well, we have a movie on that, Mike. You know that.
Yeah, there you go. So, but they don't show the fact that these people could peek inside the mortgage book exposures and know that these things are going to implode.
They see stuff that we can't see, Mike. I mean, they're experts,
No, at that time, this Burry was a normal guy living in Cupertino.
He was?
Yeah, he was a
He was a professor.
Ex-doctor. He had created this little fund,
Oh,
and but the point is he wasn't in the kind of like elitist ranks then when he took that position of $1 billion bet against the mortgage bond market. So anyway, I guess
well,
how many of us will take such bets? This is the key question, because they can wipe you out or they can make you literally very, very rich. And so I just know of two such bets. One is that Soros bet against Bank of England, and over there, I think he had inside information from that what Bank of England was going to do the next day. What's your opinion on that?
I don't know. They did it. Just like the thing that I cover is that guy in Singapore that got screwed because the yen fell down, and then he tried to go hide himself. I mean, we don't understand, but we know, we should walk the line and we shouldn't do anything illegal.
Right.
Yeah, we're not privileged like that,
That's
so
true.
we try to do our best. Like my stepfather, he said yesterday he heard 10 times off Palantir and NVIDIA. And I thought to myself, well, what does that mean to me? I mean, I just told him, when NVIDIA was at its low on December 23, Kramer was talking negative. I mean, I don't have money to gamble on NVIDIA. I mean, I lost $25,000 on straight calls because I couldn't do what Vivek taught us with the options market. But at least, actually, I've earned a lot more on, not that, Alibaba shares. I've earned a lot more, even though I've lost 25,000. But what my stepfather does and what I do is not alike. He's lost a lot of money in the stock market.
Yeah.
But other people do stuff. It has no bearing, and I really thank Vivek for giving me that reality check.
Again, like, I don't know, today's now Michael Burry is there, and we have seen people will run behind those who got their calls once in a while, right? Or maybe he's right on Palantir, or maybe he's right on Nvidia, but that doesn't mean that I should do what he has done. His situation, our situation is completely different. We have to think for ourselves. So, Marcus, to answer your question, I don't know.
Yeah, I think so. Thank you very much.
And Michael Burry has predicted 10 out of 2 recessions in the last few years. He's been wrong so many times. Maybe this time he'll be right.
No, this guy, Berry doesn't have the academic qualifications to talk about recessions.
But
I mean, he's not an economist. He doesn't have any financial background. He doesn't have any financial education or degrees. He doesn't have economics educational background. He just was a straight money investor, and he took an audacious bet, and then he succeeded. And from there, I guess you can infer whatever you want to infer.
Yeah, and he did his homework. He went through the details of all of those.
You said it. However, Vivek, I think that kind of detailed analysis exposure is more relevant in the bond market and not in the stock market. Because in the stock market, as you know, a stock is a residual claim on the bond, right? On top. So it's all generated. The value of the stock, NVIDIA stock, for example, is more dictated by news flow and excitement and hype than actual details. So that's my kind of thinking. But I could be wrong.
Guys, I had to make a call because my wife was calling. It looks like someone is coming to our home in another 5 minutes. So I have to get off from there, make sure, my house is a little clean. It is in a position to to welcome someone. So I have to go, but I'll leave you guys here to continue the discussion. Okay, and I will maybe assign Shri as always as my co-host so that it doesn't drop you all once I go from the meeting.
Vivek, this is Tom. I just want to say one thing before you hop off, and that is, I find your all the discussion very interesting here, but sometimes what I find more interesting is what is not spoken about. And for me, that's interest rates. So The current yield on the 10-year Treasury is 4.227. And looking back recently, and I'll be quick, we've had 325 basis point Fed rate cuts. Inflation, tariff concerns, by all accounts, are tame at the moment. The employment situation is weak or soft. Trump, of course, has been attacking Powell and continuously argues for lower rates. And recently he had Fannie Mae and Freddie Mac talked about them, buying bonds, buying down mortgage bonds, all those things. And yet the last time that the 10-year was 420 was on September 3rd, 4.5 months ago. And yet now we're above that level today at 422. And that's getting no attention. And if you look at a chart of yields, it's very bearish. And I think that'll surprise the market if yields continue to move higher here. I'm not saying they're going to 5% in a hurry, but it deserves watching, especially in tech, where those that follow the discounted cash flow model and higher 10-year rates obviously impact PE multiples. So just wanted to share that.
Yeah, I agree. I posted in the chat today, just now, I posted about the US yield curve. And so the shape has been actually steepening over the last several months or a year. And I think I agree with you that if the rate goes 10-year starts approaching 4.5, which is probably not very far off, then we will have to lighten up on our equity exposure. But other than that, this is a good indicator. A steeper yield curve shows that the economy is sound and capital is being allocated correctly.
Cool. Thanks.
So if 10-year approaches 4.5, that'll be a good time to now then start buying the stuff because they will be available much cheaper. Stocks will correct, and I'll wait for that opportunity.
I'll probably start looking at buying bonds, which is if 10-year approaches 4.5, because that will be the time to lock it in.
Yeah, 4.5%.
I mean, the high yield bonds will be then about 8%, 9%. So anyway, that's my thing.
Yeah, if you can live your life on those 9% for next 30 years, cool.
In the last 2 years, my high yield bond investments yielded 78% gain. So the point is, like, you have to buy these things when the prices are low, like in 2022, and they just keep going, capital appreciation and the high yield. The high implied yield was 28% in some of those, like AMC bond.
Oh, wow. Yeah. All right, I have to get off. So I will make Shri as a co-host. And sorry, it looks like some unplanned visit. Someone has come from India and
Thank you,
friend,
Vivek.
and they say, hey, we will be, coming your home. And my wife called me, hey, make sure to get off the call and open the door. I said, I'll go.
That's pretty unwelcoming.
No, it's a old college friend and looks like someone is visiting from India. So we are always welcome. Hey, just call us and land. If it's the weekend, we're always, we will figure out a way to meet. So cool. Thanks, everyone.
Thank you.